All right, welcome back to the Jason Gray Show. Wow, what a great morning so far. CPI report came out. The headline number came all the way down to 5.0% from last month, which is 6.0. That was a huge drop. Now, the core rate went up again, and we were anticipating this, and we talked about this yesterday. The reason for it is the housing expense, and that takes up 43% of this report, and it ticked up a little bit, and it had to tick up based on like the short-term rentals, like the VRBOs and whatnot. And these numbers are finally starting to crest, and you can sort of see on this report, it's starting to finally roll over. It's been about a 15-month lag for this report to start turning over. And so going forward, we got to be looking at that May 10th date. And the reason why is that's when the next CPI report comes over, and those year-over-year numbers are going to look amazing. This is going to be our start of our trend where mortgage rates start coming down. Not financial advice, by the way, but this is what I think is going to happen. And I think that we're going to see rates hit into the mid 5% range because these year-over-year numbers are going to start trending down more and more and more by replacing old high numbers. So this is going to make everything look really, really good in the eyes of everyone else. Now, the Federal Reserve, everyone's still anticipating them increasing rates by 0.25%. I think this is a huge mistake by the feds. I think it's going to roll us into a deeper recession, and they're going to have to pivot faster and harder towards the end of the year. Things are going to change. There will be a price cut on the Federal Reserve by the end of the year, maybe one or two, because the numbers are going to start looking staggeringly horrible by the end of the year. Now, some of the numbers that were up heavily on the CPI report was airline fares and then car insurance. The numbers were ridiculously high on both of those. Now, one thing that went down dramatically was used cars. Those went down huge. I mean, the numbers were cratering. Now, the reason for this is the Federal Reserve has increased the short-term interest rates, and car loans are associated with short-term Federal Reserve rates, unfortunately. Unlike mortgage-backed securities, where we rely upon the 10-year Treasury and the mortgage-backed securities that are long-term notes, car loans are short-term notes, and so those go up with what the Federal Reserve is doing. Same thing with your credit cards. So let's look forward. I want you to like and subscribe because the PPI report comes out tomorrow. Let's see how that number comes in. It should come in at line. And this is, like I said, a catalyst for things getting better. Again, the next 30 days is choppy. So if you're thinking about like you're in contract right now, lock in the loan. And when we get past May 10th, things are going to get better. Now, when rates get better, just remember right now we're in a situation where we're getting multiple offers on homes and we're in the mid 6% range. Can you imagine what it's going to be like at 5.5% with no inventory? So I had a client make an offer on a house last week, $1 million, went for $1.2 million, no contingencies, $200,000 above asking price, no contingencies, and we're at 6.5% interest rates. Think what the market's going to do at 5.5%. If you can buy now before these mortgage rates go down, you're on the catalyst of your housing prices go up dramatically. Try to get in now. I can always refinance you later. Like and subscribe. Hope you enjoy this content. I'll talk to you soon.